Hey guys, looks like we are live. So welcome to another properties and beers. So I know it's Monday. You're like, hey, properties and beers happens on a Friday. Well, guess what? I'm coming to you live and uninterrupted from Bali Airport. There's sounds telling us that the next flight's about to depart, etc. So I have to excuse the background stuff. So let's chat about properties and not beers because it's not beer o'clock yet. And unfortunately, at this particular hour, they don't do beers. So we've got something else to do. So let me say something that's going to challenge a few people tonight. Just because something grew before doesn't mean it's going to grow going forward. And that assumption right there is why many investors lose clarity. What worked in 2019 doesn't work in 2026 automatically. You know, what's accelerated a cheap debt cycle behaves very disciplined in a very, let me say that again. What accelerating a cheap debt cycle behaves very differently in a disciplined credit cycle. Markets are going to evolve and smart investors evolve with them. What am I doing? Right? We got iced coffee. I'm in Bali. Iced coffee is a thing here. And yes, I'm back in Bali, but I'm at the airport. It's a quick transit over from India. Now, for those that don't know me, I'm Goro Gupta, CEO and founder of Ethical Property Investments. We help everyday Aussies invest in high cash for property that's built to both do good and make money. We're talking real properties, real numbers, and real sustainability. You know, tonight I want to talk about two things. Actually, I might even throw in a third just for fun. Firstly, why yesterday's winners don't automatically become tomorrow's winners. Secondly, how to spot the property investment hype in 2026 so you can choose to have a look at opportunities and confidence. And thirdly, why I believe newly built is better than older properties. So the thing is, the cycle's changed and it's time to upgrade your strategy. Every cycle creates success stories. We're talking mining towns, inner city apartments, early estate adopters, ultra cheap debt, rapid growth equity, and then something happens. People stop analyzing and start assuming. They assume the tailwind's still going to blow, you know, Perth's still going to grow, this area's still going to grow, etc. But markets, they move. Interest rates get adjusted, credit settings get tightened, and supply pipelines get matured. And hey, property values go up. You know, migration reshape corridors and what's happening with my tongue today? Regulatory oversights increased. And unfortunately, people are still buying like it's 2021, thinking, hey, we're still going to make money in Perth and all these other places. You know, the market's very different. I believe for the next few years, we might have a slightly more muted approach to growth. So the better approach, I believe, is you upgrade your lens, upgrade the assumptions, and upgrade your strategy. You know, what we're talking about in 2026 has got to be a bit of an anti-hype situation. So conditions have changed. The story sold should be audited and with this kind of framework. And you've seen stuff like the guaranteed tenant story. You've heard it. Pre-arranged tenants, zero vacancy history, locked in occupancy. And here's the smart filter, my friends. Show me the actual vacancy data for this category. Show me the funding approvals. You know, model 3 months of vacancy at today's rates. Not because you expect problems and because you value resilience. In fact, a lot of our SDA properties, we tell our people, hey, you'll get 3 tenants in there if you build in the right area, but do your modeling based on 2 tenants, right? Strong investments don't need the perfect conditions of perform. And in 2022, everything was described as undersupplied, right? So I need to really cover this. Now, you know, new completions are landing. Some corridors are absorbing the new completions beautifully. Others are finding the balance, and the broad demand outstrips supply aren't detailed enough because there's some corridors with a bit of an oversupply, right? Ask how many completions are there in the next 18 months? What's the absorption rate? What's happened to the last batch? What's the vacancy rate in some areas? Because there are some parts of Melbourne, for example, with over a 10% vacancy rate, which is much higher than like, what are we at, like 1 or 2% nationally, where if you've got areas like 10% vacant. So just be careful of that because great investing is about specificity. Now, you know, I've seen things which inflate yield out there, you know, furniture pack, rent boost, temporary incentives, almost anything can look great for 6 months. And the real question is, what is a stabilized yield? Sorry, I've got some person speaking next to me on the speakerphone, but that'll just have to wait. Fun stuff about going live. So anything can look strong for 6 months. The real question is, what's the stabilized yield? Strip out the incentives and look in year 2, not month 2. Real yield's got to stand on its own, not this whole turn into an Airbnb situation that I've seen some clients really fall in for. And at the end of the day, we've got to look at serviceability, right? It's important. Serviceability matters more now. I'm seeing more people come through with like 600 and 700K serviceability. That's well below where the median price of property is at. Really, you need to be looking at serviceability of 800, 900K plus if you want to be looking at a really high quality property, because buffers matter. Portfolio sequencing matters. And so ask your broker, what's the portion of my income that's shaded? What's happened if the rates stay steady for 2 years? What happens if they go up? What's the buffer look like already? Are you building in a 2 or 3% buffer that brokers build in? And that good news is most brokers actually build in a buffer into the interest rates. I believe we're sort of at the top end. You might have 1 or 2 interest rate increases depending on what the government decides to spend the money on in this day, on this week, right? When I say this week, I'm tongue in cheek there. So look, expansion today is strategic and planned, and that's a good thing because the whole negative gearing situation is over. Like negative gearing and wait story. Hold it for 5 years. Equity's going to come and ride the cycle. Sometimes that approach fits, but serious investors really do model it properly. How much is the capital injection over 5 years? Will it stabilize? What does refinance look like under today's lending rules? Today, more than ever, we're in a place where cash flow is really important and lifestyle is important because the cost of living has gone through the roof, and more people don't have the same money that they had in 21 and 22. The spare cash flow, right? Unfortunately, the RBA decided to slug the best of our property investors and owner-occupiers with things that they didn't need to be slugged with. That's my personal opinion. They had other levers that they could have pulled, not the RBA, but the government had other levers they could pull to calm down inflation. But unfortunately, they left in the RBA's hand, which kind of sucks. And now, if you've been listening closely, a lot of this also applies to specialist disability accommodation, NDIS, SDA. SDA's got a real opportunity, real impact, and real nuance, which is why it rewards investors who value clarity. And so on Thursday, this Thursday coming up, February 19th, 11:30 a.m., I'm hosting a live webinar at one of my own properties that's basically already been tenanted. I can't say it's actually been tenanted because it hasn't been registered yet, but the tenants are ready to go. They're waiting for the registration to happen, right? On that session, we're going to walk through vacancy data, category level differences, funding mechanics, oversupply pockets, what the cash flow model, the real cash flow model looks like. Because you know what, I chose to accept, 1 or 2 participants with lower funding, what that looks like in that real scenario. And by the way, those that are curious about STA, I'm still going to receive about, $240,000 income from that property every year as a gross rental income. But we're going to break it down and turn that into net at that webinar. So make sure you're there, 11:30 on Tuesday. Now, I want to talk about one other thing that's a little bit controversial. That's new homes versus existing homes. But before we do that, this coffee needs to be drunk. If you're here watching, come say hi. Drop me a comment, by the way. I can see there's a couple of people watching online. Now, let's address something directly. There's an old adage in property. I establish in a blue chip area, land appreciates, new builds don't grow. That makes sense in certain cycles, but today, I reckon that needs updating. New houses are no longer the inferior options. In many corridors, they're the growth engine. Why? Because growth follows demand. And you see, we've got immigration pushing up vacancies. So people who come to this country want land. I mean, I just came back from India where people live in apartments. That's sort of the thing there. But when they move to a place like Australia, they want land. We are the lucky country, right? So we have a lot of the outer areas which are growing, but you have to be careful where in the outer area. We've got to make sure there's not too much oversupply in that area. So the question is, where is demand flowing right now? What are the new infrastructure corridors? What are the affordability-driven migration areas? What do the master plan communities look like? People are choosing new areas and capital follows people. And if it's okay, I'll share a personal example with you. I'll give you a very simple, real example. My own owner-occupied home, an existing house in a well-established area, about 12, 15 kilometers from the city, grew by about 20% over a period of about 4 years. In that same time frame, in a growth corridor where I chose to put my investment property, that grew 40 to 50%. It's the same cycle, but different performance, right? Now, that's not universal, but it shows something important. Growth today is not about old and established. It's where momentum is building. And momentum, my friend, is key. That's really more important than what's established and not established. And the good thing, there are some huge advantages to buying new, right? Let's get practical. New home come with some structural advantages. We're talking about, full capital works depreciation, new fixtures and fittings, and that improves after-tax cash flow significantly. We talked about cash flow earlier. That is really important to focus on, especially when you're trying to build a life. A lot of people have families, right? And you didn't just build a family to try to, go to work every single day. And so cash flow is really important, and strong cash flow supports holding power. We've got lower overheads because we've got lower maintenance, fewer surprise repairs, less, we've got actual warranties, right? And modern energy efficiency. The good thing is tenants also prefer that area. We've got modern layouts, energy efficiency, and that supports consistent occupancy and rental growth. We're seeing, places in new areas get similar rents to the middle ring in terms of per week rent. And I never thought we'd see newer areas get, even in co-living, for example, the growth that's happening in terms of rental, but that's happening in new areas. Now that's different to SDA. With SDA, we've got to look at established areas, and we'll talk about more about that on the webinar on Thursday. Now, the 2019 rulebook said you've got to buy old and established somewhere for growth. The 2026 rulebook, my friend, says buy where the demand is accelerating and where cash flow is good. And that often means newer corridors, right? So this doesn't mean old is bad, new is always better. It means the strategy's really got to match the cycle. So right now, housing supply is controlled. Demand corridors are really clear to those that know. And I like our one-step in strategy. I like to buy one suburb in from the growth areas, the sort of new areas. That means they've got more growth potential because the suburb next door is getting built. And the tax benefits are stronger up front. And new builds are, I believe, aligning with more that what the market needs today. And that's why we prefer them. So once again, inviting you to the SDA webinar where we actually look at established areas, a little bit conversely to what I've said, but even in some established areas, if you buy right, you can get an immediate uptick in growth. That's only an immediate uptick if you develop it right. So I'll leave you with this. Markets don't reward nostalgia, they reward adaptation. So if you're still investing based on what worked 5 years ago, you're missing out on what momentum is building today. So stay adaptive, stay informed, stay disciplined, and follow ethical property investments for our weekly breakdowns and properties in this case, not beers today, because I believe the alignment will outperform assumptions. See you at the webinar. I'll see you on Friday. Cheers, guys.